What kind of earning growth prospects U.S. small caps offer comparing to the rest of the market?
I think that this year you're beginning to see small cap revenue and earnings growth compare favorably with large caps. And this is manifesting itself in two different ways. One is revenue growth in smaller companies has actually accelerated beyond that of both mid caps and large caps. And this is in contrast to what you saw in the last year. I think part of the reason for that has to do with how much business small companies do which is non-domestic in comparison with larger companies. But the median non-US revenues of smaller companies is substantially lower than either mid-caps or large caps. And I think this is helping both their revenue growth and their earnings growth. Another way this is manifested is in positive earnings revisions. And if you look over the last 12 months of the percent of companies that are seeing positive earnings per share revisions, it's very interesting. But large caps, it's less than 1%. Mid caps are about 1.5%. And small caps are just over 6%. So again, this is another quantitative sign that small caps are well positioned. So probably it has most to do with the fact that they are more domestically based.
Where do you see the highest quality in the US small cap universe?
Well, our portfolio has always been focused on very high quality businesses. And the most important quality characteristic for us is free cash flow. So for example, we like companies that are able to self-finance their growth. To the extent they can do this, they cannot be held hostage. They're not dependent on healthy capital markets. Most of the small cap market, most small companies need to either sell debt or sell equity in order to finance their growth. But our portfolio is, they have bulletproof balance sheets and very solid cash flow characteristics. The other thing we look for is we like to see above average profitability. And here we tend to focus on above average returns on assets.
Are you interested in the M&A theme? You think there's going to be a slowdown in this segment of the market?
Well, it's interesting. We have never invested specifically with the idea of buying companies that will get taken over. However, we have had many, many takeovers over the years. And I think the reason for that is larger companies, if they're buying a business, they're tending to look for a small company that has a dominant market share in a niche, where buying the company gives them an entree, and it can fast forward the larger company's entry into a different market. I think that very recently takeover activity has slowed down a little bit, and it has to do with a lot of uncertainty having to do with the macroeconomic environment. However, I think when you look at the amount of cash on the balance sheets of companies, number one, and number two, the fact that I think everyone agrees that the secular outlook for economic growth everywhere is going to be somewhat lower than what it's been over a period of time. If you can't come by growth in the usual way, you're going to buy it. So we actually have had a couple of takeovers this year. I think that it's very possible that you'll see an acceleration in that. But in the US, I think businesses are waiting to find out, they're waiting to see a little certainty, which can only come after the presidential elections. As you know, right now, our Congress has been incapable of doing anything to come to a compromise to deal with our own budget deficit situation. So unless they can resolve this issue, there are automatic cuts which come into place in the beginning of January. And we very often refer to that as the fiscal cliff. I think that a lot of companies are waiting to see what kind of rules, what kind of taxation levels are going to be implemented. And frankly, nothing is going to happen before our elections in November. But I think that once there's a little bit of certainty, it will unleash a tremendous amount of M&A activity.
You think actually right now US small caps are undervalued and they are derating compared to the rest of the market?
I'm so glad you asked that, because it's extremely interesting when you look at the relative valuation of large and small. If you look at valuation as enterprise value as a multiple of EBITDA, then small is not overvalued relative to large at all. It's, I would say, a little bit less than average. So it is attractive. Also, we didn't talk about the quality characteristics of large and small, but there have been a few changes since the big financial problems all companies had in 2008, 2009. But now, if you compare cash as a percentage of total assets, it's actually higher for small companies than large companies, which is counterintuitive. And also, if you look at debt levels, strangely, at this point, debt as a percent of total assets is actually lower for small companies than large companies. Then there's another quality characteristic which is harder to measure, but it has to do with pension funds. Older companies, very, very large companies, have their retirement plans in the form of defined benefit plans, where the liabilities are enormous because interest rates have been close to zero now for years. Most smaller businesses have what we call defined contribution plans. 401ks, where they don't have to deal with these off-balance sheet liabilities. So it's another area where the quality of small is better than the quality of large, although it's qualitative, it's hard to see. Then I just want to make one other observation, because if you're looking at the valuation of small versus large, it depends very much which part of the small cap market you're looking at. So for example, if you break out both the S&P 500 and the small cap Russell 2000 into quartiles of quality, and you measure quality by return on invested capital, the lowest quality sector of the Russell 2000 is significantly overpriced relative to the S&P 500, on the order of 35%. And it's interesting because lowest quality is the most overpriced. The second lowest quality is still overpriced, but less. Then the next quartile, which is better quality, is slightly underpriced, and the highest quality quartile of the small cap market is significantly underpriced, which is very, very interesting. And you can also see it in broader market statistics, whereby if you're looking at valuation ranges and where there might be vulnerability, it would look like the cyclical aspect, the cyclical portions of the market are trading at profit margins which may not be as sustainable, and the multiples are higher than usual, whereas the less economically cyclical companies, where you would think intuitively that the earnings multiples would be higher, are actually lower than they usually are. So I think that this is a time of tremendous opportunity, specifically in this very, very high quality portion of the land of small caps. And it happens to be where we always are. It doesn't always find itself in favor, but I think that the valuation characteristics today are quite compelling.